Good afternoon and welcome to the Friday edition of the Sharesify podcast. Steve and James are here as always. How are you guys?
Hey, Ian, very well.
Looking forward to the weekend?
With trepidation now that the Premier League season is about to hit us. Of course, the Championship also. That's old news for you too, isn't it?
Yeah, thanks for that, Steve. Yeah, we'll be looking forward to that. As usual, quick romp through markets. And this week has been interesting because in the background has been brewing this sort of worry over government debt to GDP, and it's kind of exploded this week to the extent that Japan has been buying back its own debt, but the Treasury in the US has been buying back its own debt, trying to bring yields down. What they want to do is they want to bring the price of money in the market down, because bond yields are what set things like mortgage rates in the States. And so they're trying very, very hard to do that. The problem with that is it gives the willies to equity investors, because equity investors start to think, oh, we need a bit more of a equity risk premium to be going and buying stocks. The other thing we've seen is that more companies have started to come out and kind of miss forecasts. So, Steve, you've been looking at low risk value stocks this week.
Yeah, I mean, we know that investors are massively exposed to the AI trade, and with good reason. But we also know that increasingly, as valuations have increased and in many cases ballooned, inevitably that's going to lead investors to worry about, are we in bubble territory, all of that. Now, we've discussed these issues in both verbally on these podcasts and also much more in depth in features. So I won't go back into those details, but fundamentally, there's clearly an appetite for people to look for lower risk quality options. So I looked at some I pulled together 10 stocks effectively that are basically just that. They are not really exposed, barring the odd one. They're not really exposed to the massive AI trade, but they're still very strong businesses. They're generating cash flow. They pay out massive dividends. So these are the kind of companies that investors may feel more inclined towards if they feel that AI valuations are reaching a real peak level. So that's definitely worth having a look at.
Yeah, absolutely. You also took a look at the Korean chip makers, because what's going on there?
Well, I mean, it's a really interesting point here. So SK Hynix and Samsung, the big hitters on the Kospi, the South Korean index, they both basically come out and said that they're going to completely rethink their shareholder returns policies. So effectively, that means much bigger share buybacks and much bigger dividends down the line. Now, what's really crucial about this is it sends a massively powerful message to markets that this is not a short-term blip. They're not going to commit to massive cash returns to shareholders if they don't perceive that they can maintain that in the longer term. So you've now got an AI trade argument, but you've also now got a much higher cash return element in terms of shareholder returns. So ultimately, it's blending AI and looking at also shareholder returns much more front and center. So this is going to be a powerful message, I think, to investment markets in general, and they're going to be increasingly looking across the AI ecosystem at other companies and thinking, are you going to look to up your share buybacks, maybe increase your dividends, etc., etc.? And the other crucial element to think about with Samsung SK Hynix is for years it's been applied this Korean discount. We've seen it in Japan as well, a similar dynamic. And it's because there are issues around governance, or there certainly have been in the past. And the idea of returning more cash or more value to shareholders by buybacks, by dividends, etc., kind of eases that. They've been making massive strides in terms of improving governments. So that is sending another powerful message that that Korean discount should narrow to European stocks, to US stocks. So these are really powerful features. And I think that's where we saw share prices. I think Samsung went up about 9%, Hynix about 12%. And it's more than just about chips and about foundries. It's about the whole business as a whole. And you as shareholders, me as shareholders, getting a better return than just looking for share price spikes.
Yeah, absolutely. How about that? Growth and income from these guys. And James, you were looking at, well, we talked about disappointments. We had one notable one, didn't we, with JD?
We did with JD. Updates from a couple of retailers that suggest the US consumer is now really feeling the strain. So Walmart, world's biggest retailer, Q2 raised guidance, but the US like-for-like slowed quite a bit. and I think that's given the market the nervousness around the state of the US consumer. But Walmart's going to reinvest some of their tariff refunds into slashing prices to win shares. So that's the sell-off to me looked a little bit harsh. JD Sports a little bit more worrying. So quite a severe profit warning for FY27. That kind of youthful shopper is pulling in their horns. The World Cup didn't really provide a boost in Q2, which I thought was a little bit odd. So the organics were down 4.5%. So I'm a little bit cautious on that kind of athleisure sneaker market, where I think shoppers are really pulling in their horns.
I suppose, James, it's always a difficult position from a retail investor point of view to look at retail sales and think, oh dear, things are going south, because it's so capricious. I mean, it can really perk up in the next couple of months. So just seeing one kind of poor set of figures from JD certainly, and perhaps slightly weaker on the Walmart front, doesn't necessarily change the fundamental investment story there. It's really a case of just following the dips and the curves, because retail consumers are so capricious.
Yeah, absolutely. I think that's probably the case with Walmart. On JD, the noises from management were a little bit more cautious, so they expect this kind of muted market to persist for a while longer yet. Nike going through this turnaround, so there's kind of a lack of newness in the market. But I think to me that's going to take longer to turn around. Walmart is more of a short-term blip. That's my take.
Yeah, so that's a good point.
Yeah, I mean, this is the problem with visibility, isn't it, right at the moment for a lot of firms? You had Hays come out with its full year results, and although there was we knew already what the quarterly net fee income progression was, and we talked about this in a note about is it time to buy them, because the rate of decline was slowing. That second derivative was slowing, and people would say, "Oh, yeah, we've hit the bottom." Even Hays were thinking we might have hit the bottom. Came out this week and said, we haven't really got any visibility until September. That's a big month for us. We won't find out until October, November what's going on with them.
And of course, it slashed its dividend in as well. So, I mean, that's a really strong signal. It doesn't feel comfortable paying a dividend at the previous level. So it's 2/3 slash dividend, massive.
Absolutely. The one that I found most interesting, and this will sound a bit odd to everybody, because we've done our deep dives on big US tech stocks and so on, is this little AIM-listed company based in Chesterfield called Robinson. And it's only about a 20 million market cap, but these are always the canaries in the coal mine, these small companies, because they start to suffer much quicker than big companies when the market changes, when the economy changes. And Robinson makes plastic and cardboard packaging. So it's been around 200 years. 1950s, it kind of made its name. It did the plastic tops on the pack of Smarties. Today, it does plastic and cardboard. I mean, just about anything you buy in the supermarket is either going to be in a plastic bottle made by them, or a tub if it's food, or it's going to have a paper wrapping on it that's made by them. And what's really interesting is they said in their AGM update in May, now their financial year ended in end of March, they said conflict in the Middle East had meant they'd seen increased prices for energy, polymer, freight markets and so on, but limited effect on trading because they had some stockpiles. They did say if it carried on, then they might have to think about raising prices. Well, they came out this week and they said, yeah, those pressures have actually lasted longer than we thought. And, we're now also facing difficulty getting hold of materials, and we're not sure we're going to be able to recover these increased prices through price rises to the customer. And I think we might see a bit more of this as we go through Q3 with the results. We're going to find out which companies can raise prices and which companies can't raise prices. I mean, these guys, as I say, their product is ubiquitous across most food and personal and household good manufacturers and across the supermarkets. So if they can't raise prices, you do wonder who else is going to be in the same boat.
I think as well, Ian, my single observation about a company like Robinson is that if you're doing lots of plastic packaging, we know we all live in a world now increasingly looking for less packaging period, but specifically less plastic packaging because of the implications for the environment and so on. So I do think that's likely to be something that's hung on investor sentiment over time. And it'd be interesting to see what kind of messaging they send out or have sent out in the past, because, on a PE, mid-single digit PE, clearly they're not really convincing the market that that's not going to be a massive issue in the long term.
Now, next week, chaps, what are we looking forward to?
James,
Bobby-
you've got some posh
Yeah.
drinks coming your way, haven't you?
Very excited about this one. So Pernod Ricard full year results on Thursday. I think the key one here is, has the organic sales improvement continued into Q4? I'm not so sure it will have, given the sort of downbeat noises from Diageo the other week. But obviously, importance of the spirits market, US, China, India, and it's really a good opportunity to check in on the recovery there, and it'll offer quite an interesting read across for Diageo.
I think that, James, that's one of the brands that really takes me back to childhood days, raiding the parents' drinks cabinet, a bit of Pernod.
Oh.
that takes you back to the Pernod and Advocaat. They were the two that stick in my mind.
Oh,
Yeah, they've
my
also
word.
got Jameson whiskey, Absolute vodka, so they could give you a nasty hangover if you get stuck into their brands.
Let's hope investors don't get one.
Yeah. All I can throw in for next week is the Pru, which of course used to be, on every high street, and it was a sort of, a feature of everyday life here. Well, they barely do any business here now. It's all Asia and Africa, and they're going for that market big time. So it'd be very, very interesting to see what they say. I mean, in terms of, annual premiums, it's kind of bigger than Aviva. So it's a big old company. It's a FTSE 100 stock. Be interesting to see what they say next week.
I mean, it's got one of those brands that it's been around for so long. It's trusted. So when people go to comparison websites and look at life insurance policies or other stuff, they see a Pru and they think, well, I'm probably not going to fall too foul by buying a Pru product. Whereas some of the new entrants into the market, you may be feeling a little bit less secure. So they likely benefit quite a lot from that. Let's just go to a really safe as houses organisation.
Yeah, brand power. And talking of brand power, doesn't come much bigger, does it, Steve?
No, well, I mean, the elephant in the room is going to be next week. It's going to be, of course, Nvidia. It's the biggest company in the world. It's the biggest, it's the chip champion of the world. It's been dominating stock markets for about 3 years and maybe even 5 years. Key thing here is, can it send a message when already expectations are so very high? It's been absolutely knocking forecast out the ballpark, beating. I think it's something like about 12 or 13, maybe 14 quarterly reports that have beaten on revenue and earnings. It's just quite remarkable. So the questions are going to be, can it sustain that? But what is the messaging? Always going to be looking forward. It's not about the current figures, the Q2, it's going to be about Q3, Q4 and into fiscal 28. That's what investors are going to be really interested in. And the share price has made some gains this year, but it's not been the real superstar it's been in previous years. And that's because investors perceive the valuation to be really toppy. Actually, though, if you look back at evaluations, it's trading on a PE around 20 times now. So compare that to some of your Walmart, for example. I think that typically trades on PEs in 25 times. So you start to, I think a lot of investors are starting to look at some of these companies like Nvidia and say, it's really overvalued now. I'm not going to buy any more. But actually, they've not really checked the valuation, and it's worth keeping your eye on these valuations because forecasts are moving ahead so rapidly. So absolutely go and have a look at the shares and have a rethink after these results are out, after the market closes on Wednesday, to see what you genuinely think about the company, and don't presume that PE ratings of 6 months ago, 12 months ago are the same today. So it'd be really fascinating to see how the markets do react to those figures.
Yeah, I was going to check with you when it was. So, as you say, Wednesday after market, we'll know a lot more about the world going forward, won't we?
Sure, absolutely.
Right, I think that's us for the week then, fellas. You and me, Steve, got our shirts on. Hoping for a bit of sunshine.
I mean, the weather's turned a little bit more sour now, but we're still clinging on to the summer days.
Clinging on to hope, mate. Clinging on to hope. With that, we'll wish you a good weekend, and we'll catch you next week. Bye for now.
Take care, listeners.
Yeah.